You started with an assessment of asset-like companies and stocks. So how are you describing this to your clients?
Well, this has been the rage, for the last 10 years, Charles, that companies that have primarily intellectual capital as what they're selling with very wide margins and a lot of very smart people that work for them, those generate enormous free cash flow because every dollar of earnings doesn't have to be redeployed into building new hard assets. You just keep growing and the free cash flow accrues to the shareholders. So this has been one reason why the stock market valuation's gone up a lot the last few years, because these free cash flow generating businesses are viewed as very attractive. But what the AI phenomenon is starting to suggest, and it's a fair enough question, is these businesses are perhaps more vulnerable to being AI disintermediated or,
Right.
amorphic than the regular businesses. And so maybe there's some value in the value stocks, if you will. And so that what we've done is we've told our client base, look, the valuation multiple on the market here probably needs to come off. We've been among the people calling for a fair value on the S&P of 22 times, which takes into account the large amount of these
Right.
asset-light businesses that are perhaps worth more. And we've cut that multiple down to 20 times.
So
And
you
when you
answered a
do,
question you answered a question I'm going to ask you toward the end of the interview, but I wanted to stick here for a moment because first of all, have you seen anything like this? Or could we equate this? You mentioned a 10-year span where software, intellectual property has enjoyed these wide margins, free cash flow, higher valuations. So have you seen a paradigm shift like this before where it's about the new moat, capital intensive, hard to replicate with the AI software? Or is this, in your mind, just a temporary moment in time?
I'm not sure, Charles. I think it's more than a temporary moment in time. I think the world is really changing. And, history rhymes. It doesn't really repeat itself. But if you think back to the 90s, when you had the big, the initial rise of TMT and the internet, there was a lot of concern out there with the, say, box hard goods retailers that were going to be disintermediated by internet shopping, as an example. And ironically, Amazon is one of the stocks today that's really been hit pretty hard. But what the lesson I took away from that was, one, a lot of the internet winners didn't end up being winners. They didn't really have the wherewithal to take advantage of some of the things that they had on offer. And some of the losers took a little longer to play out than people anticipated. And what really happened was the whole market shifted towards asset heavy businesses. The period of 2002 to 2007, in particular, those 5 years, the
Right.
value stocks had a great run. So I don't know, maybe it's a little bit of a rhyme. I don't think it's quite the same playbook here, but it does feel to us like these asset heavy businesses are going to have their moment in the sun here.
Right. So, and people should really pay attention to this because a lot of folks are just sort of writing it off. The knee-jerk reaction has been dismissive. But to your point, I think it's gotten Wall Street's attention. In fact, we'll put up now for the audience the changes in your targets for this year and next year. And you already answered this question, right? Earnings actually have gone even higher, but your targets are lower, both for this year and next year. Still robust stuff. So let's talk about how to play it, because you're looking at $3.25 this year, 7,500. You've got a couple of ways of looking at it. First, on the defensive side, Verizon, Chevron, AbbVie. What is it that they have in common that should make people feel comfortable holding them?
These are big diversified businesses that have a base of assets that are unreplicatable, and that are trading at a reasonable valuation, particularly on a dividend yield basis. They're throwing off dividend yields between 3 and 5%, in case of Verizon, a little bit higher than that. And they're growing those dividends partly because of AI and the efficiency benefits that it can bring to their businesses. They're growing those dividends at 3 to 5%. And if you're in a world here where the market's looking to maybe be high single-digit returns, suddenly a stock that gets you half of that in cash in hand through a dividend starts to look more attractive, and that's kind of what's happening here.
Let's go to the growth picks. You like Paychex, Amazon. We know a lot about those names. Resolute is a name that's not necessarily familiar with our audience. It was on a hell of a run until it ran into a buzzsaw in December. It went from, it got chopped over in half. It's starting to chip its way back. Why do you like this one? Obviously, the risk is a little higher here.
Yeah, and I brought this up, Charles, I think on the day it crashed in December, and it's up like 150% since then on your show. And we were, I warned your viewers at the time, this is a very speculative stock. In full disclosure, we have a large position in the name. We think we know it reasonably well. And, it's got a very strong set of drugs coming in the field of dialysis and, immunology and that kind of thing. And we think that pipeline, has to get through some pretty speculative tests and things like that. This is not for the faint of heart. This is a speculative name, but I think it's one that, our analysts feel really could probably double or triple in the next year or two.
Yeah, I mean, just looking at this chart, with these kind of names, they hit an occasional hiccup like this, and it would not be surprising if it actually did do that. I will note for the audience, you like Japan here. We don't have enough time to go into the details, Stephen, but thank you very much. Appreciate you. Wish you came on more.